Are you tired of your crypto holdings being as stable as a toddler on a sugar rush? Well, let me introduce you to stablecoins. In this video, I'll be explaining what they are, how they work, their risks, and why they're so important. Hi, I'm Linda. I'm the owner and operator of the Marvel stake pool in Cardano, and I've got a soft spot for crypto. So let's dive into stablecoins and talk about these incredibly vital pieces of the DeFi ecosystem. You might wonder, why would we want to invest our capital in stablecoins anyways? We've always been told to hodl our cryptos, right? Well, generally speaking, stablecoins help us store value in times of market volatility. We are able to convert crypto into stablecoins as prices go down, and we're able to rebuy our positions when the market begins to climb again. It also opens up options for real-world vendors to be able to accept stablecoins and not have to worry about a loss in profit due to market volatility. And it allows loans to be of fixed value with fixed interest rates so we can plan for financial futures. Traditionally, on most blockchains, we have three different types of stablecoins: fiat and commodity-backed, crypto-backed, algorithmic stablecoins, and in true innovative SingularityNet fashion, they have come up with the fourth type called tracer coins. Stablecoins are essentially a cryptocurrency that's designed to be stable in value. And while they all might look the same on the surface, when we actually take a closer look, they're all vastly different. The biggest stablecoin by market cap are fiat-backed stablecoins. Fiat-backed means that for every dollar in stablecoin, there is $1 in cash or other highly liquid assets stored in a bank. This way, the stablecoin will retain its value as it is almost always redeemable for $1. Next, we have crypto-backed stablecoins. These stablecoins are typically over-collateralized and are technically loans. A user will take a stablecoin loan against the value of their collateral. The collateral will be locked into a smart contract at a set level of over-collateralization. When purchasing one of these stablecoins, first you'll have to choose your own collateralization ratio. Keep in mind that your collateralization ratio will have to be above the protocol set minimum, which, let's say for this example, is set at 120%. So let's say you put in the minimum of $120 worth of crypto as collateral for $100 worth of stablecoins in return. How much collateral you choose depends on your risk level. The more collateral you're willing to put into the protocol, the less likely it is that it will get liquidated in case the value of your crypto falls. Should the value of the crypto backing the stablecoin fall below the protocol set minimum of 120%, then the collateral will be liquidated. This is to preserve the value of the collateral in case the crypto price continues to fall. In theory, this will ensure that any stablecoins in circulation will have at least $1 backing them at all times. When you decide to pay back your stablecoin loan to redeem your collateral, the stablecoins will be burnt and removed from circulation. Many of us crypto veterans have probably already heard of algorithmic stablecoins, and mostly for the wrong reasons. However, there are many algorithmic stablecoins out there that have easily withstood the volatility of 2021 and 2022. Algorithmic stablecoins are still fairly new to the DeFi scene. They range from uncollateralized to fractionally collateralized. They are backed by either the coin of the native blockchain, by other stablecoins, or are solely reliant on the algorithm. In simple terms, these stablecoins function by an algorithm that monitors the circulating supply of the stablecoin. Should the value of the stablecoin increase above $1, then the algorithm will mint more stablecoins to make them more abundant and therefore lowering the price again. Should the value of the stablecoin drop below $1, the algorithm will burn stablecoins to create scarcity and drive the price back up again. And now we have Cogito's Tracer Coins, which is a SingularityNet spin-off. The Cogito protocol looks at stability from a different perspective, relying on indices that perform a long-term upward growth. As Ben Goertzel mentioned, stability doesn't intrinsically mean correlation to fiat currency. They are unique on many fronts as they are not pegged to any fiat currency, but instead to non-financial indices. The first token will be soft-pegged to a green index that is tracing the movement of positive environmental progress. The benefit of this is that they are resistant to direct inflationary pressures. The slow and steady progression towards carbon net zero should make them less volatile and a low-risk asset class. They will function similar to other over-collateralized crypto-backed stablecoins. However, additionally, the stabilization mechanism is supported by AI-powered algorithms. The risk-weighted reserve will be backed by both liquid and illiquid components that will have an incentive mechanism for investors to provide them to the protocol. Artificial intelligence will help determining what balance of risk will back the tracer coin, along with minting, burning, and other parameters. Part of this risk management will be encouraging diversification among multiple asset types backing the tracer coin, as well as distribution of any storage/usage for the assets to ensure that one singular event will not be sufficient enough to cause catastrophic damage to the reserve. All of these stablecoins have some sort of risk. It is up to you to determine which of these risks are suitable for your needs and your investing strategy. Fiat-backed stablecoins carry the risk of the bank that holds the funds collapsing, which is also known as counterparty risk. While in 2022 we thought this was nearly impossible, in 2023 we have seen banks collapse due to multiple reasons. One of the leading stablecoins, called USDC, almost instantaneously depegged to the supposed shortfall of funds. Extreme measures had to be taken to save the bank and therefore the stablecoin. So while the stablecoin did not fully collapse, it highlighted the risk of bank collapses for all to see. Fiat-backed stablecoins also tend to be centralized, which means that as an investor you'll have to put a lot of trust into them. There's always the risk of fraud, corruption, negligence, and incompetence when humans are involved in the process. Crypto-backed stablecoins are subject to market conditions. In a downwards market, it is possible that even the liquidated funds no longer cover the amount of stablecoins in circulation. Also keep in mind that having your collateral liquidated can lead to significant losses in capital. Most of these projects are decentralized in nature and the management of funds is run by smart contracts. And whilst this is great, there's always the risk of the smart contract being hacked and the funds drained, which is also known as smart contract risk. And if there are no funds left backing the stablecoin, then its value will go to zero. We saw with the large fiat-backed stablecoin USDC depegging that this also led to a depegging of many fractionally backed algorithmic stablecoins, as the USD backing them was no longer worth $1. Another well-known algorithmic stablecoin, which is Luna's UST, also depegged after the perfect storm occurred. The process began with a potentially malicious actor dumping millions of UST, which caused the initial depegging from the $1 value. This then combined with a poorly designed algorithm that dumped an already depressed Luna price even further. The end result being that both UST and Luna went to zero.
Deploying more capital. Steady, lads.
Cogito's tracer coins have some risk in that they can be susceptible to a bank run while they are at a low liquid capital point. In this case, the reserve may contain too many illiquid assets that cannot immediately be cashed out, such as fixed-term deposits. However, Cogito will have the ability to sell those illiquid assets and distribute retained profits in order to boost liquidity. And as always, there will be smart contract risks. And now that we have covered all of the basics, let's dive into figuring out which stablecoin will suit your needs best. Fiat-backed stablecoins are less complex, and for the most part they're much more stable as they're reliant on the US dollar to maintain its value. This also makes them highly scalable as their backing comes from the US dollar instead of a cryptocurrency with a limited supply. Crypto-backed stablecoins are important for those jurisdictions where loans are counted as non-taxable events. When we need liquidity but don't want to sell our crypto and incur large tax bills, we can take loans against our crypto and then cash out the stablecoins into the market and pay for whatever we need. These stablecoins are also decentralized in nature, which means that you do not need a bank of your own to be able to mint them. This allows the unbanked to begin the process of being their own bank in places where they may not have been otherwise able to. Algorithmic stablecoins don't require users to expend large amounts of capital. Should you wish to sell $100 worth of crypto, then you will get $100 worth of stablecoins in return. This means that you don't have to worry about being liquidated like in a crypto-backed loan or have to have access to a bank to be able to mint fiat-backed stablecoins. The biggest pros of Cogito is its low volatility and the fact that it is not pegged to a fiat currency, which means that they don't carry as much risk in the regulatory landscape as other stablecoins do. The lack of a fiat peg also means that they're not as susceptible to direct inflationary pressures, and they could potentially appreciate in value since they're soft pegged to non-financial indices. There's only one question remaining now. Why do we need so many? Well, to put it simply, risk mitigation. It allows us to diversify our stablecoin holdings over multiple different protocols. The solid, well-designed and secure stablecoins will stand the test of time and will continue to be an integral part of the DeFi ecosystem. And that's it for today. Thanks for tuning into my TED Talk and keep being awesome. I'll see you next time.